how to calculate IRR, internal rate of return, on a cash value life insurance policy. In this episode, I'm going to explain why this is important and how you can calculate it. If it's a simple cash value insurance policy where you're putting in a level premium for a set number of years, you can do that on a financial calculator. But most people put in variable premiums and lump sums and what have you, and that's a more complicated calculation. So in this episode, I'll explain why and how you can calculate it and why that is very important if you're using life insurance, cash value life insurance, for tax-free accumulation of money and tax-free income, such as for retirement, as an alternative that actually can knock the socks off of setting aside money in a tax-deferred IRA or 401k. So I'm Doug Andrew, and I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans prepare for a comfortable retirement. And when people are socking away money for their future, they don't want to outlive their money. And I discovered a long time ago that there's 3 big dangers that cause most retirees to outlive their money. And they are still prevalent dangers to this day: taxes, inflation, and market volatility. Now, I like to make people immune or eliminate those dangers from retirees by using properly structured, max-funded insurance contracts. But of course, if you've watched very many of my episodes on this channel, without question, my favorite financial vehicle to accumulate money tax-free under Section 72E of the Internal Revenue Code, and then be able to access that money and turn on tax-free income. What I'm talking about is that every $1 million that you accumulate inside the insurance contract can generate a 10% payout, $100,000 a year of tax-free income without depleting the $1 million principal if you live to be 120 years old based on actual historical performance, and is tax-free. And then, of course, at the end of the day, when you finally do pass away, anything left there transfers tax-free and usually blossoms, increases in value. There's only one financial instrument in the Internal Revenue Code that does that, and that is a cash value life insurance. Now, having said that, most permanent life insurance, cash value life insurance in this country, is not designed to accomplish an internal rate of return, what is called IRR, that retroactive back to the first day you took out the policy, that will be within 1% of the gross rate of return. And if you're going, what did he just say? Okay. So let me explain by telling you a few stories. Years ago, I was teaching a room full of financial advisors, and there were 3 or 4 in the room that, up until that point, that were big, whole life insurance proponents. And whole life insurance and term insurance were the only 2 types of insurance that were around until 1980. Okay. And so whole life insurance, if you're not aware, is where you pay usually a level premium. It has guarantees, and it means that you way overpay than the actual cost of insurance. The early years, let's say you start at age 30, and so you're way overpaying the early years so that you can underpay the latter years when life insurance gets more expensive as you get older, because all insurance has a pure mortality cost or term insurance component in it, okay? Whole life, universal life, term. Now, whole life, it's been a good product for death benefit for years. It accumulates cash value. That cash value is tax-free because the government says, we don't want to hurt those who are trying to take ownership, that if they live a long time or they die sooner than later, that they will not be a drain on the government for welfare, widows, orphans. So why would we tax the inside buildup of cash value, the dividends and the growth? Okay, so it's been sort of a sacred tax-free cash cow if it's used to maximum fund. The truth be known, most life insurance that has cash value, permanent life insurance, now there's whole life and universal life, or index universal life is my preference. Those are the two main types of permanent life insurance that accumulate cash value. Now, in 1980, E.F. Hutton, who was the brainchild behind the emergence of universal life, and then 17 years later, when interest rates started to come down, they introduced index universal life, so you could still earn a higher rate of return. But what E.F. Hutton wanted to do is take the least amount of insurance that the IRS would let them get away with and put in the most money, the most premium the IRS would allow. Now, sometimes agents don't understand what I just said, but in the 1980s, when this was introduced, the IRS challenged it, and E.F. Hutton won that lawsuit. But then the IRS went to Congress and said, we got to change the definition of tax-free accumulation of money inside life insurance under Section 72E, 7702, and 101A. Now, those three sections of the code is what allows money inside of a permanent life insurance policy to accumulate tax-free, access that money while you're alive tax-free. When you die, it transfers income tax-free. Nothing else does that, by the way, in the Internal Revenue Code. Now, if you're using it for living benefits, when the IRS convinced Congress to pass some tax citations called TIFRA, DEFRA, and TAMRA, in a nutshell, it allowed universal life to be funded with the same amount of money that you could put into, let's say, a whole life policy, but you got away with less life insurance death benefit because your objective wasn't trying to get as much insurance as you could for, let's say, $500,000, because I had many clients putting in lump sums back in the 1980s. What I'm saying is back in 1980, a 60-year-old that wanted to reposition $500,000 so it would grow tax-free, so that it would double to $1 million within 7.5 years or 10 years. With universal life, that person that wanted to put in $500,000 only needed $1,250,000 of life insurance. And they could get that money in after TAMRA was passed in 1988 in as little as 4 years and 1 day. That 60-year-old, they could put in $100,000 a year, $100,000 the first day of the first year, every year the first day. And so in 4 years and 1 day into the fifth year, you could get the money in there, whereas whole life took 7 years. That's why it's called the 7-pay. And whole life required more death benefit. So whole life was more expensive, and it took longer to fund. And that's why those are two of the big reasons why whole life doesn't perform quite as well as max-funded indexed universal life. But in 2020, because of COVID-19 and what was going on in the economy, they changed the amount of insurance required, and that allowed, with indexed universal life, that same 60-year-old to only have to have maybe $1 million of death benefit instead of $1,250,000 if they wanted to reposition $500,000. So the death benefit required to accommodate the amount of money you wanted to set aside is less. That means the insurance costs even less now than it did in 1980. You're able to put in the money actually faster. So if I have a 6-year-old that wants to reposition $500,000, instead of only being able to put in $100,000 a year, let's say, they can put in maybe $125,000 a year now. So in 3 years and 1 day, they can pretty much have it funded, where it used to take 4 years and 1 day. They can get the money in even faster now. Now, that is one of the big reasons why properly structured, max-funded index universal life will accumulate a higher amount of cash value in a given time period than whole life. Let me try to simplify this. When I was instructing and teaching a bunch of financial advisors one day, there were about 3 of them that were whole life agents, and they were very intrigued with index universal life. And when I mentioned IRR, they sort of got this puzzled look on their face. And I said, well, what's the internal rate of return on your whole life policies at age 65 if you're maximum funding it. And they went, well, it's 8%. I go, no, that's your gross rate. That's what the dividend rate is. What's the internal rate of return, cash on cash? And they said, well, our supervisor says it's 8%. I said, no, it isn't. Now, basically, to calculate internal rate of return on cash value insurance, you take the amount of cash value that you actually achieved, if you want to know what rate of return you actually got cash on cash, net, after all costs and fees, because the insurance costs something, okay, and there's fees in there. You can take the actual result, or if there's a projection, and so these agents were projecting 8%. And so I said, what's the cash value at age 65? And they told me, and I said, you've been using a level premium. Now you can do this with a simple, financial calculator. I took the premium, whatever it was, $500 a month or $1,000 a month, and I put that into the financial calculator for 30 or 35 years from age 30 to 65. And I said, what is the actual internal rate of return? So it's saying in order to end up with this much money, the cash value they said that policy would have at age 65, grossing 8%, what was the internal rate of return to get that? And it came out at 4 point something. And they were like, what? I said, you're not netting 8. You've got all these fees and so forth, the cost of the insurance. They were shocked. They had never been taught how to calculate this before. So I said, well, what's the cash value projection out at age 95 if they don't use this for tax-free income? And so they gave me that number, and I went retroactive back to day one, and the internal rate of return was 5.9, okay? I said, so in order to achieve this at age 95, this client on these premiums would have to be earning 5.9% compounded rate of return every year to end up with that much money. And they were shocked. They thought, wow. So I said, in essence, you're having to earn 8 to net just under 6, and it takes till age 95. Let me show you, based on actual historical performance, a property structured max funded index universal life. At age 65, the cash value, okay, with the amount of premium in there, if you earned 9.6, which is what I had averaged on just universal life before index universal life came out, if you earn 9.6, you would net 8.6. Basically, I said, I can earn 9.6 and net within 1%, 8.6 cash on cash. I can net more than you're grossing on your whole life, and I can do it by age 65. That's where they got this huge epiphany. But in actuality, by rebalancing, having annual reviews and diversifying, I'm able to earn a higher rate of return than most max funded index universal life policies. I've been able to bump that rate of return up to 11.17, and I can net over 10. I can earn 11 and net 10. That's 10% internal rate of return, cash on cash, which is one of the reasons why every $1 million can generate $100,000 a year of tax-free income without depleting principal, if you understand rebalancing your portfolio and diversifying on an annual basis. So I don't want to get too more complicated than what I've done here, but that's how you calculate the IRR, or internal rate of return, on a cash value policy. If it's a level premium you're paying monthly or annually, you plug that in as the investment, the contribution. You take the projection, or the actual what it achieved, and you just simply calculate what was the internal rate of return. But most of the time, people are going to be putting in different amounts of premium into a flexible premium product like universal life. And so that's complicated. If you put in $500 a month, then you increase it to $1,000, then you stop for a little while, then you resume. You put in a lump sum of $10,000 another year. That's the beauty of index universal life. It can accommodate lump sums. Whole life requires a certain set amount in order to have those guarantees they talk about. I don't worry about the guarantees, because the guarantees are to keep the death benefit, because a property structured max funded index universal life, most of my clients' cash value grew to equal and then exceed the death benefit within 10 or 11 years, okay? And so I don't need to worry about guarantees when the cash values grew to equal or exceed the death benefit. So I would encourage you to watch other episodes on this channel to see actual illustrations, and you can even study it in my book. But what I just said is a complicated calculation when you've got varying amounts going in. That requires a sophisticated software program, which is actually a high-speed trial and error that says in order to end up with this much money and these premium payments are variable going in, that's extremely complicated. Truth be known, it takes, well, is the rate of return average 12 or as little as 2? And if it falls within that range, then it lowers down the 12 to 11 and a half, and this one moves up to 3, and pretty soon it whittles it down. It used to take, of course, weeks for those calculations. Now it takes nanoseconds. But it will tell you within 1/10 of a percent, 1/100th of a percent, the IRR, internal rate of return. And the same is true if you have a client that says, well, I have this much money in my IRAs or 401ks. Now that's before tax. You have to calculate what that is really worth after tax, because $1 million in an IRA or 401k at a 33% bracket is only worth maybe $700,000 in a 30% combined federal and state bracket. But to end up with $700,000 of your money versus a tax-free investment, what rate of return would you have to be getting in order to achieve that rate of return? And sometimes people are shocked. They go, I've only been averaging 4.5. And my asset manager says I've been averaging 7 or 8. Well, yeah, they've been using certain sets of time. So IRR is an important concept to understand, and you can have it calculated with a good software package, or you can have an advisor show you what the internal rate of return is on any investment, retroactive back to day one. And of course, when you have an indexed universal life insurance contract structured, all of the agents that I train always create a report to show you the IRR at any given time, every single year, retroactive back to day one, so that at age 60 or 65, retroactive back to day one, maybe when you started it at age 30, if you earned 11, you'll net 10. If you earn 9, you'll net 8. And that's if you properly structure it, compared to other investments where you may have to earn a much higher rate of return to have the same net that max funded IUL can do. Does that make sense? So if you want to learn more, check out some of the other episodes up here, or you can study my most recent best-selling book, The Laser Fund. Click on the link below, and you go to laserfund.com and you contribute a nominal amount towards the shipping and handling on this. You can purchase it on Amazon for anywhere from $20 up to $60, but I'll give you a copy for free. You simply contribute a nominal amount toward the shipping and handling if you click on this link, and I'll cover the rest of that cost, and I'll pay for the book and fire out a hard copy to you via priority mail. And when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's options there for that. We also teach free educational webinars on a weekly basis. And you can even schedule an appointment with an IUL specialist to see how a properly structured, max-funded index universal life can perform, and make sure, you ask for an IRR report year by year by year, because most advisors will not run that for you. I think it's because they're embarrassed, okay? Or they don't even know what it means. So you can do that, no cost or obligation, with an IUL specialist, but this is an important concept to understand if you want the best net internal rate of return, cash on cash, after all taxes, fees are included. Does that make sense? This is to your brighter future.